Okay, so this is the first video regarding Accounting 231, which may very well be the first time you've ever been exposed to any accounting information at all. Now, it is possible you've seen some of these ideas and concepts in a high school accounting course, or if you've taken this course in the past and you're now retaking it, but I cannot emphasize enough how important the information contained in these first three chapters is really going to be. Because the information in these first three chapters that we're going to go over is going to be the building base or the foundation for everything else that we do throughout the rest of the semester. So please take the time not to gloss over these first couple of chapters thinking this information is so boring or so useless, especially in chapter 1, because chapter 1, while we have a lot of terminology, a lot of ideas and things, those form the entire reason that the accounting profession works the way that it does. And everything in this course is going to make so much more sense to you if you really get a good understanding of these ideas covered in chapter 1. So the very first thing that we want to talk about here in an accounting course, of course, is what is accounting? So what is it? Is it just numbers? Is it really complex math, which may be what you've heard? What is accounting? So, according to your textbook, accounting in its most fundamental state is simply this. It is an accounting, not an accounting, right? We're defining accounting. It is an information and measurement system that does three things. So 1, identifies transactions. 2, it records those transactions. And 3, it communicates the information contained to decision makers about the organization's business activities. So if we put all this together and we just go through it in one reading, we say that accounting is simply an information and measurement system that identifies, records, and communicates an organization's business activities. And that's all we're going to be doing this semester. So it's kind of funny when you think about all the many hours we're going to put into discussing this and all the work that's going to go in behind the scenes on your end, that really it all boils down to one sentence. We want to identify, record, and communicate an organization's business activities in accordance with what we will see in a minute that is called GAAP, which is generally accepted accounting principles in the United States. So, now, the one question you might have at this point is, well, I know somebody, and they're not an accountant, but they're a bookkeeper. What's the difference? Are accountants just bookkeepers? Are bookkeepers accountants? Is there some distinction? And while they're related, typically we think of accounting as a more complex idea than just simple bookkeeping. The big difference here that we see is that accounting includes analysis and interpretation of information, whereas bookkeeping may just be you writing down everything that's happened. The accounting piece is the actual analysis and that actual interpretation that goes in once you have gathered the information. Now, we talked about this idea of communication. But when we communicate, there's basically two groups that we want to talk about communicating with. The first group is what we call external users. So these external users have a couple of key things in common. They do not directly run the organization. So this is not our management team. And they have limited access to information. So these are the main 2 points that we're going to see with our external users. Now you say if they have limited access to information, what information do they have access to? And the information they actually have access to is what we refer to as the financial statements. Now, the financial statements from this point on in the semester, I will abbreviate almost exclusively as FS. This is simply so we don't have to wait on me to write out financial statements 1,000 times over the course of the semester. There are, in fact, 4 financial statements that we will be concerned with during this course. The first is what we call the income statement. The second is what we call the statement of retained earnings. The third is what we call the balance sheet. And the fourth is what we call the statement of cash flows. Now, by the end of the semester, you will know how to prepare all 4 of these, and we will prepare them periodically throughout the course. So as you get to these in the textbook, please do not just gloss over them as they talk about how to prepare them, as this could be a key component to your exams, to your homework assignments, to various quizzes that we may see in the course. So please, please, please pay attention when you see these items come up. Just as important as knowing what they are and what is on them is knowing the order of preparation, which is listed here. This order is so important because the way these are related, information must flow down to be able to complete each one of these properly. Now, you say, I'm already getting the idea that I'm probably going to have to know a lot of lists and a lot of things in this course, and while that may be true, I will try to help you any way I can by giving you acronyms. So here's the first acronym you will be seeing in this class. It is ISBS. Now, the only problem here is you've got to make sure you know which of the S's comes first. But as long as you know that, then it should not be too much of a problem. And what this ISBS is going to tell you is something I can almost guarantee that you agree with, is that I should be sleeping. And this is how we're going to remember the order of preparation of our financial statements. The I is for income statement. The first S is for the statement of retained earnings. Then we've got the B, which is for the balance sheet. And finally, the last S, which is the statement of cash flows. Now, as we get through the semester, we'll dig into each one of these and you'll understand why this is the order they're prepared in. For now, I just want you to see it, to have it in your notes right away, so that whenever you come back and you're studying for the exam, right there, hopefully on the first page of your notes, is this a very important order. So this gets that for you right away. Now, what we're going to see now is who these external users actually are. So we said that all they've got access to are these financial statements. They don't have access to the internal workings of the organization, but they do have access to those 4 pieces of information. Now, the groups that we're going to see here are people that we call lenders. The lenders are people who loan money or resources, right? It doesn't have to be money, or resources to an organization. So maybe instead of going to the bank and getting a loan, you go down to a equipment place, to an equipment store, and you borrow 10 tractors, right? Well, they are lending you those tractors. They have an interest in your organization succeeding and you taking care of the tractors. All of these types of things, they are a lender just as much as the bank who gives you a loan is a lender. The next group that we want to talk about here are our shareholders. Now, our shareholders are slightly different than lenders. They have still given money or resources to the organization, but instead of requiring repayment of that money or of that resource, however that has come in, they instead receive ownership. So these are the owners of the organization, more specifically, the corporation. Things that a shareholder is going to be concerned with are the idea of, should I buy? So should I buy more shares of stock? Should I sell my stock? Or should I hold my stock? So if I'm buying more stock, what I'm most likely saying is I believe this company will be successful, and therefore I want to have a larger ownership in it so that I receive more of the rewards when this company does well. Maybe to sell it, I'm saying either I think the company has reached its peak and I want to get out while it's at the top, so I can sell it at a high price. I think the company is going downhill and has already started, but I don't want to lose any more money than I already have, so I'm going to sell it. Or maybe I've just gotten to the point where, maybe I'm 75, 80 years old. I've had this stock for 40 years, but now I want to get something a little bit safer for my retirement, right? Maybe something that pays a higher dividend, whatever the case. There are many, many reasons you may decide to sell a stock, but this is an idea and an item that the shareholder is going to have to consider. Or should I just hold it, right? Maybe you are retired and you do have a significant number of shares in a company like Walmart. Love or hate Walmart, they are very, very consistent. They have paid an increasing dividend every quarter for like 25 years. They are a wonderful investment if you want continuous cash flow in retirement. They are about the best company out there because they have such consistent dividends. Now, who knows what could happen with Walmart? They could tank tomorrow and you could lose every penny you invested. But odds are Walmart's been around for quite a while. They've been paying nice, consistent dividends. Shareholders seem happy. Walmart seems to be in a pretty good place. The next group that we want to talk about is what we call the Board of Directors. The Board of Directors from this point forward will be abbreviated as BOD, so I don't have to write out Board of Directors and you don't have to wait for me to. So, if you see BOD, think Board of Directors. Now, the goal here, or the role rather, of the Board of Directors is to oversee the organization. So the Board of Directors is going to do this or play this oversight role primarily by evaluating the performance of management. So, how does this work? Who elects the Board of Directors? Can you just walk into a company and sit down and be on the board, or is there some formal process? Well, hopefully you guessed there is a formal process. Companies don't just allow anyone to come in and look at their records and have this critical role of oversight in their organizations. So how do you get put on the Board of Directors for a company? And the way that is going to happen is by election of the shareholders. So the shareholders will vote and say, these are the people that we want on the Board of Directors. The Board of Directors will then hire the senior management, your CEO, your CFO, your COO, on and on and on. Those people will then hire the managers below them, who will hire the managers below them, who will hire maybe the employees, and on down the list it runs. But it all begins with the shareholders and the Board of Directors. Now, the last external group I really want to focus on right now is what we call the external independent auditors. Now, while all of these people are external to the organization, the standard for auditors is set significantly higher than the general public would have to see to be considered an external user. To be a lender, you simply loan money to the organization. You could be the brother, the sister of the owner of the organization, and that is fine. If you are auditing the organization, you must be completely external. There are so many rules and regulations that go into if you're even able to audit this organization based on if you own shares in that company, if your brother or your niece, and all these rules that come in. But what we want here is to say, look, these other external users are relying on information provided by the organization. So the organization is preparing the income statement, the balance sheet, the statement of retained earnings, the statement of cash flow. They're preparing all four of these financial statements and sending them to the bank, perhaps, to say, please give me a loan for $200 million. Well, what do we think about the quality of those financial statements? If no one else has looked at those financial statements, you can see that there might be a huge incentive for the organization to fudge some numbers around and say, oh, we actually have this much in sales and not this amount. Or we actually only paid this much on this expense instead of that much. And so they might be willing to move some things around to make them look a little bit nicer, a little bit prettier for that loan. So before those financial statements are used, typically what we require is an external audit. For any publicly traded organization, this must be done annually. So there's an annual audit for every publicly traded organization. So what do these people do? These external auditors are going to primarily focus on examining the financial statements of the organization to ensure proper preparation in accordance with what we're going to see on and on and on in this semester, GAAP. So in accordance with GAAP. So GAAP, as we defined earlier in the video, is the generally accepted accounting principles. And that is GAAP. Those are the rules and the regulations that define how we handle transactions in the United States of America. We are the only country that uses GAAP. Other countries use variations of IFRS or variations of their own reporting frameworks. So be careful if you're comparing a U.S. company to something else, as it might look a little bit different. But if you're comparing companies that are all U.S. based, their financial statements should share quite a few similarities. Now the book goes through many other external users. I'm not going to talk about them in this video. Please do read through them. Make yourselves familiar with how these other groups are externally related to the organization. They include non-managerial and non-executive employees. So that's one that gets a lot of people because they still are employees of the organization. But if I am just a low-level employee of the organization, I probably do not have access to high-level financial information any more than someone else might. The regulators, so maybe they have a legal authority. Voters, government officials, contributors, suppliers, and customers. Now, customers is another one that gets a lot of people because we think if I'm buying a product, maybe I'm not pulling up their financial statements before I go buy, a bike or before I go buy a car. But maybe you should. Because if you're buying a car and that car comes with, say, a 5 or 8 year warranty, if you pull up that company's financial statements and it looks like they might go out of business in the next year, do you think they're going to be able to honor that 5-year warranty? And the answer, of course, is no. They will not be able to honor that 5-year warranty, so they're going to lose that warranty because there's going to be no one to abide by it. So before you buy something with a long life or a long warranty, it may be worth taking the time to go pull up their financial statements and just see, do they look healthy? Do they look like they're going to be around for the long haul, or do they look like they're going out tomorrow? So these are all things you want to think about. Now, just like there are external users, there are internal users. So internal users are the people that are managing the day-to-day, are managing the organization. And so what we're going to see here is who counts as an internal user of the financial statements. And do they have to follow all the same rules for reporting as we might have for external users? So the next thing we want to look at are internal users of financial statement information. So these internal users are going to come in and they're going to directly manage the organization. So these directly manage the organization. Internal reports are frequently designed for the unique needs of managerial and executive employees, such as a CEO, for example. So typically, these may not follow all of the rules that you see in GAAP. And if you want information on those and the decisions that you might make as an internal manager, that is covered in Accounting 232, which is managerial accounting. So there we get away from GAAP some and we say, how can we manipulate this information in a way that makes it very easy for a manager to very quickly look at this and make good decisions? Maybe they don't want to see everything in terms of GAAP. They just want to know what's happening today. They don't necessarily care that it goes through all the filters that we have to use to get this information acceptable to GAAP standards. We just want a quick rundown of what's happening in the business today. So oftentimes, those internal reports are a little bit more simple, a little bit more easy to prepare. So I'm just going to list out a few of these, and we'll talk very briefly about them. But hopefully you'll notice pretty quickly what they all have in common. So the first one here is the purchasing manager. The next one is the human resources manager. I'm just going to abbreviate HR because that's typically how we refer to human resources. And then production managers. So hopefully you've already noticed one similarity in that they're all management. So your internal users are primarily the management team of the organization. They all play different roles. For example, your purchasing manager needs to know what to buy, when to buy it, how much to buy, and how much to spend, right? All of these things are things that your purchasing manager is going to be wondering about. Your HR manager is going to need to know how much are people making, so they're going to need to know payroll information. They're going to need to know what types of benefits are they receiving. Are they receiving health care, vision, dental? Do they have life insurance through the company? Is the company paying for all of this? Or is the employee paying for some or all of it? And they need to know, how are they doing as an employee? Is their performance well? Are they doing a really good job? Are they excelling at their job? Are they doing average? Are they underperforming? And if they're underperforming, why are they underperforming? Are they underperforming simply because of incompetence or simply because they're lazy? Maybe they don't know what they're doing. Maybe they weren't really qualified. Maybe they lied on their resume. We don't know. But why are they underperforming? Is it something else? Do they have a sick child at home? Do they have a sick family member that they're staying up late to take care of? Are there things that we can do as the organization to ensure that we can work with them while they're getting through this tough time so that when they get through it, they can come back and be a really productive member of the organization? Because while we may really be hurting with them out for, say, a week or two to take care of something, when they come back, they'll be so appreciative of that time that we're going to most likely earn their loyalty and get a far more productive employee than if we just kept them to the grindstone and refused to give them that break that they desperately needed to take care of whatever it was in their life that was bothering them at the time. So that's an HR manager. That's the role they're going to play. A production manager, we're going to monitor costs and ensure quality. So it's not enough to make sure that we are in budget. We need to make sure that what we are producing is quality. Because if we produce substandard goods, then yes, initially, maybe we were fantastic. We only spent half the budget, and that looks wonderful on a cost report. But what happens when 3 months down the road, every item we produced comes back either through a warranty, through a repair, and now our customers are very dissatisfied. We've got negative reviews everywhere. We've got terrible publicity. The cost to the organization from that is far worse than the cost of just doing the job correctly the first time. So make sure you're getting quality products and quality work done. Now, if this is your first accounting course, you may be wondering, why on earth would I want to do accounting, right? What are the opportunities that are actually out there for accountants? So there's three broad areas I'm just going to talk about very briefly. The first is what we refer to as private accounting. The second is what we refer to as public accounting. And the last is what we're going to refer to as government and not-for-profit accounting. So government and NFP accounting. Now, out of these, private accounting is what happens when you go to work for an organization. So say you go to work for Walmart, you go to work for Brookshire Brothers or Nissan or Toyota or some business. But you're going to go work for them and you're going to do the books for that business. That is private accounting. So this is working for businesses. Public accounting is what a lot of people think of as the only option when they're approached right toward the end of your undergraduate degree or your master's degree in accounting. Somebody may approach you and say, tax or audit, right? Like those are your only two options. And they are fantastic options. I did both of those in public accounting. I enjoyed them both tremendously, but they are only two of the options available to you. Government and not-for-profit accounting, this is where you're talking about regulation, law enforcement. You've got maybe you're going to work for the city. Maybe you're going to work for the county. Maybe you're going to work for the state, right? All of these are government and not-for-profit positions. So maybe you're going to work for the local water treatment plant, right? That would be an accounting position that might be needed. Maybe you're going to go work for the Red Cross. That could be an organization that's hiring an accountant. All of these things need accountants. So you say, well, what are the actual job opportunities out there? Are 90% of jobs in public accounting like everyone makes it sound like? Are most of the jobs private? How does that split work? So what you'll find is about 54% of accounting jobs are accountants working for businesses. This is private accounting. Now, only 24% of jobs, roughly in the accounting industry, are related to tax or audit work, and 22% of jobs are related to government and non-profit accounting, roughly. So as you see, while it is often made out that tax and audit are really your only options, there really are other options available. So do keep that in mind as you near graduation, and maybe look into some of those if you think, tax and audit don't really sound like the deal for me. Tax, you're primarily dealing with individuals or businesses, and so you're helping them save money when it comes time for their taxes to be due. Audits, we're really not there to be the bad guy, to be the boogeyman, to get you, right? That's not our goal, is not to catch you committing fraud. Our goal is to make sure that you're providing reliable information that is prepared in accordance with GAAP. 9 times out of 10, the auditor is going to be much friendlier when it is the auditor that you have hired than the auditor that is coming from a regulatory agency. So work with your auditors. When they show up, they're not there to hurt you. They're not there to throw you in jail. They're there to make sure that you're doing everything correctly. And if you're not, we're there to help you get that corrected before someone else comes in and it is a big deal, right? We're there to help. So please don't treat us like we're there as a hostile party. We're not. We want to help your business succeed, and your business will be more successful if you have good accounting records. So the next question that we've got to look at is this idea of ethics. Now, a lot of people care more about their money than they do about anything else in their life. As an accountant, you're dealing with their money. Do you think ethics matter? Do you think you can lie to your clients? Okay. The idea that we want to drive in here is that ethics matter. They absolutely do. So, when faced with an ethical decision, how do we make sure we make an appropriate decision? So I'm going to write down the steps for us, and then we'll talk through one hypothetically really quickly. So the first piece of this decision-making process, we want to identify the ethical concern. The second thing that we want to do, analyze our options. And third, we hopefully make the ethical decision. And this is the decision process that we will use. So I'll give you a situation here, and we'll think through how we should handle it using this model. So identify an ethical concern. So you're sitting at your desk one day, and your boss comes up to you, and he says, or she says, we are a little bit short on meeting our sales quota this quarter. So it's the end of the year. It is December 31st. And he says, we have this sale that we're talking with somebody on the phone right now, and they're going to put in the order, and we're going to fill it on January the 4th. But I want you to go ahead and book that sale as of today, or as of yesterday. Okay, say as of December the 30th. All right, I called him yesterday. We were talking it through. We finalized it today, but nothing has been written. Nothing has been filled. There's been no work done on our end. Nothing has happened other than this conversation on the phone. But I want you to go ahead and book this sale in this quarter, in this fiscal year, so that we hit those sales numbers. So there's the ethical concern. Should you record this sale in the wrong period? And your boss tells you, you either do this or you find other employment. Right? I'll find somebody who will do this if you do not. So here's the situation, okay? You're sweating, you're nervous, you know you spent all these years in school working on an accounting degree, you got out, you got your CPA license, and you know this is not appropriate. So you think, what are my options here? I've basically got two options. The first option is I do it. I subordinate my judgment. I say, I know this is wrong, but at the end of the day, my boss told me to do it, so maybe I can do it and get away with it. Because if anything ever comes of this, I can just say, oh, my boss made me do it, right? Well, that's not going to hold up. You're still going to lose your CPA license if you do this, if it ever comes out. So, one option, do this. Commit fraud, break the law, break every piece of ethics you've ever been taught. The other piece is to stand up and say, no, I'm not going to do this. This is not the appropriate course of action. If that means you have to fire me, then please do so. But I will not compromise my integrity. I will not stain the profession like this. So you can either deal with the ramifications of not meeting the sales quota, and that might mean your boss doesn't get a bonus. It might mean you don't get a bonus. It might mean shareholders react violently and they sell off a huge portion of their stock and tank the stock price of the organization. There's no telling what the ramifications could be. They may be terrible, but they are what the company should incur because that is what the profession says. We report honest, reliable information that is not biased. And that's the goal of what we do. And then we communicate that information to our shareholders. So you've got the option of either saying, no, I'm not going to do it, and maybe losing your job over it, maybe destroying yourself, your reputation, maybe people at work look at you differently, whatever the case is, or you can bend and you can say, fine, I'll just do it. It's just a couple of days. What's the big deal? Now, the last piece here is you have to actually make that decision. So you're going to have to make a decision. You're going to have to act. And hopefully what you'll do is you will say, no, I will not do this because that is not the appropriate treatment. So there's our process, and that is a situation you could very well find yourself in if you go into public accounting, private accounting, anything like that. You may see situations like that coming up, and you've got to be able to deal with those. Now, I briefly mentioned a term that you've probably heard in the past, and you may not have known exactly what it meant, but the term that we want to look at now is fraud. So there is this running joke that maybe as accountants or especially as auditors, maybe we should just have a fraud button on our desk and we just whack it every time we find a mistake someone made. They committed fraud, they committed fraud. But that's not true. So say, for example, you're working in accounting and you have been on the clock for 14 hours that day. You skipped lunch, you're exhausted, you're hungry, and you're writing this report to try to get it to the boss before the end of the day so he has it on his desk or she has it on her desk first thing in the morning to review, and you make a typo. Boom. You dropped a zero on an expense. You didn't mean to. It wasn't intentional, but you made a mistake. Your boss glances through it in the morning. They look at it, they say, in the past, you've always done exceptional work. So they're not really checking the details. They're just checking the form, making sure everything looks roughly right. It gets through them. They pass it on. Now it's time for the auditor to come in at the end of the year. The auditor comes in and says, whoa, this doesn't flow. Nothing is working here. Where did this come from? And they ask you for the support. You can't provide it because, of course, the number is wrong. And the auditor says, okay, we've got an adjustment that has to be made. Has the auditor just found a case of fraud being committed? No. Fraud was not committed. A mistake happened. Mistakes happen in accounting. They happen in every profession. It's not the end of the world if a mistake occurs. So what differentiates a mistake from fraud? And fraud has one key element that differentiates it from an honest mistake, and it is intent. So fraud is the intentional deceit of another party for what we're going to call personal gain. This may be financial, this may be reputational, this may be some way, but you did this knowing it was not correct because you wanted something. So go back to the example we talked about a second ago where we said you've got this problem of your boss wanting you to record this sale in the wrong period. Well, in that case, that would be a fraudulent act if you did that. You would have just committed fraud because you know not to do that, but yet you decided to anyway. So there is your fraud. Now, when it comes to fraud, there is this thing that we refer to as the fraud triangle. So the fraud triangle has 3 pieces. The first piece that we're going to talk about is what we call opportunity. So this says that you have the ability to commit fraud. Maybe you're the CEO. Your organization has wonderful internal controls in place to prevent fraud from occurring. But because you're the CEO and you've been there 40 years, you are given the ability to override any transaction that was recorded. So you say, I don't really like this one being recorded. I'm just going to nix that transaction. It's not in the books anymore. It's gone. There's nothing there anymore showing that we incurred this expense, this liability, whatever the case is. But you have the opportunity to commit fraud. Or maybe it's a much smaller scale. Maybe you work a cash register. There's no camera behind there. There's not good record keeping. There's not really a good system of receipts. The business doesn't really know what was sold during the day, what your cash balance should be. It's not a very well-run business. It's a very small shop. And you say, well, I'm just going to take this 20 off the top. Nobody's going to know because there's no records, there's no security, and you have the ability to do that. There's your opportunity. The next piece that we want to look at is what we call financial pressure. So financial pressure says maybe there's a reason that I feel I need to take this money. It could be something as noble as you have a very sick parent who's at home who you can't afford their hospital bills and you're wanting to help them because they helped you your entire life. And you regret that maybe you don't make enough money to be able to take care of them the way you wish you could. So you're going to steal this money out of the register to help alleviate that burden. Or maybe it's something as greedy as maybe I want that 10th beach house. Maybe I want that 10th sports car, right? Whatever it is, there's some perceived financial pressure the individual has that makes them want to commit this fraud. And the final piece is what we call rationalization. So rationalization says, okay, I have the opportunity, I have the pressure, and I feel I am owed this from the organization. So it says, I work 70 hours a week all year long. I've worked 3,500 hours a year every year for the last 10 years. And since I'm salaried, I don't see a penny of overtime, a penny of extra pay for all those extra hours. So because of that, I feel I'm owed this extra money. And you're not, right? You signed a contract. You agreed to the terms. If you didn't like the terms, you should have negotiated a better contract. But you've agreed. You said, yes, that's fine. I'm good with this rate of pay. I'm good with these hours. Whatever the case is, you made an agreement, so you need to honor it. But rationalization says, I can make myself feel okay about it because I am owed this. The other side of rationalization says, even if you believe you're owed this, even if you believe that you have the opportunity, the pressure is there, everything in the world is lined up, and you get away with it. You have committed the perfect fraud. You've covered every track. No one could ever find it. No one would even know where to begin looking. You've gotten away with it. Who knows that you've committed this fraud? Certainly nobody else, but you know. You know that you've committed this fraud. You know that what you've done is wrong. So you're going to have to be able to look yourself in the mirror every morning and know that I have committed this fraud. Now, another way to look at rationalization is to say, I'm going to borrow $100 out of the cash register today. It's Thursday, but I don't get paid till Friday, and I've got a bill due tonight. So I'm going to take that $100. I'm going to pay my bill tonight, and when I get paid tomorrow, I'll put the $100 back in the drawer. Maybe nobody will notice. And you may very well intend to do that, but you do that. You notice, hey, I had that money for a day. Nobody noticed. So maybe next time you borrow $200. You intend to repay it, truthfully, but then you have a tire go flat, and now you spent that $200 on a repair that you didn't expect. So now you have no way to repay that. And you notice nobody said anything. So you say, well, maybe next time I'll try to steal $300 and $400, and it begins to spiral. Eventually, you'll steal enough that you will get caught. But this is the rationalization piece. It's this internal idea of, can I justify this to myself? So, as the business, which of these three do you think we can work to eliminate? Because you're going to need all three of these to be able to pull off a fraud. Well, can I deal with the financial pressure? Perhaps. Maybe I could just pay my employees more. But maybe the business is barely getting by as it is. Everybody's working on a bare minimum salary. Nobody's living extravagantly. And there's really not a way to bump pay. So we can't necessarily do anything about the financial pressure. I definitely can't get in my employee's head and say, don't do this, don't do this, don't do this. But what I can work to eliminate is the opportunity. So the way we're going to eliminate opportunity is through something that we call internal controls. So whether you've heard this term before or not, I guarantee you are familiar with some of these internal controls. So let's just talk about one example really quickly. You work a cash register at Chick-fil-A, and you think it's a busy time. Maybe nobody will notice if I slip a couple of dollars in my pocket. Everybody's running around like crazy. There's all this chaos. Nobody will notice, whatever the case is. Well, what is likely above your head when you are a cash register? There's probably a camera watching you and watching the money. So they're going to see very clearly if you take that money and put it in your pocket. Another idea of internal controls in this cash register scenario is the idea that at the beginning of each shift, the register is balanced to ensure that it was properly done at the close of the last shift. Maybe in the middle, you balance as you get a break for a few minutes. You balance to make sure there haven't been any errors. And at the end of the shift, the lead cashier, the manager, somebody comes around behind you and balances that drawer themselves to ensure that every penny is there that should be there. All of these are different types of internal controls that are going to work to ensure that you don't have the opportunity to commit this fraud. It's helping the employee protect them from themselves. Maybe it's a locked door to prevent access to an important area. Maybe it's passwords. Maybe it's different layers of security or key cards or anything like this. All of these are going to be internal controls. Maybe it's an alarm system, right? Who knows? But the possibilities for different internal controls are almost limitless. There are so many different options for different things that you can do as a business to eliminate or even completely remove the opportunity for someone to commit fraud. So the goal here is to enforce it in the employee's mind that they can't get away with it, so please don't even bother trying. It saves everybody a lot of time and a lot of hassle if we can do that. Now, very quickly, there are two major ethical failures that have occurred in the accounting profession fairly recently, in the last 20 years or so. And what these are the failures of Enron and WorldCom. Now, there are frequent accounting jokes regarding these two about how we in the accounting world love to pick on Enron and WorldCom, and we absolutely do, because the scandals that occurred here are incredible. And it shows a huge black eye on the stain of the profession of accounting. So we want to make sure we don't have these types of infractions occur again. Because of the massive, massive ethical failures that occurred in Enron and WorldCom, where they did things that should never have been done, Congress decided to act. When Congress acted, they passed what is called the Sarbanes-Oxley Act. Sarbanes and Oxley is the last name of two of the Congress people who were responsible for this. And frequently you will see this abbreviated as SOX. I will not be writing out Sarbanes-Oxley ever again. If we refer to it, I will simply write SOX as SOX. So hopefully you will know what we are referring to. SOX has many, many provisions, but the two we want to make sure that you understand are that management, so MGMT, management must issue and sign a report stating internal controls are effective. They must also state that there are no material misstatements on the financial statements that they know of, right? There's no material omissions. They don't know of anything that they're trying to hide or keep from the auditors or keep from public knowledge. There's nothing that would change someone's opinion that they know about. So they're not hiding stuff under the bed to say and to try to get away with something sneaky. And the second provision is that auditors then verify the internal controls are in place. Now, here, this is simply a statement, right? You say, okay, auditors verify internal controls are in place. How long could that possibly take? It takes an incredible amount of time. For an organization as large as Walmart or Berkshire Brothers or anything, maybe not Berkshire Brothers, but Walmart, Nissan, Toyota, for these types of places, especially that are international, the amount of processes that are involved can be hundreds or thousands of processes, and every one of them is going to have a memo that dictates exactly what internal controls are in place, if they are designed effectively, if they're operating effectively, who is in charge of them, how do they run. I mean, we're talking maybe thousands of pages just in these memos. So this is an incredible time sink for an audit. This was a huge, huge hammer that got dropped on the accounting profession when Congress said, look, we trusted the accountants because of all this high and mighty speak of being ethical and everything to police themselves. They proved that they couldn't or wouldn't do it, so Congress is stepping in to fill that role. So the auditors will then verify that those internal controls are actually working as intended. Now, should a CEO or CFO knowingly sign off on a fraudulent set of financial statements, they can face millions of dollars in fines and substantial prison sentences. So, do not sign this lightly. If it is then found after you've signed this that you knew that there was a fraud occurring in your organization, you will be broke and in prison because they will fine you a tremendous, tremendous amount of money and throw you in jail for decades, typically. So huge, huge penalties if you violate the ethical concerns here. While we're here, I just want to drive home the point that ethics matter. There are many shady people in professions, and surely there are enough shady accountants that are unethical. If you are not ethical, please do not go past the basic courses in accounting, because we do not need any more unethical people in the field. We have our share. We do not need more. If you are going to be a liar or a cheat, please do it in some other profession. The accounting profession needs honest, ethical people who will do what the profession calls you to do, to follow the rules and to ensure that reliable information is passed along to the needed recipients. So please do make sure if you go into this profession, you are honest. We do not need any more dishonest accountants. Now, the next piece of legislation that we want to talk about is the Dodd-Frank Consumer Protection Act. The Dodd-Frank Consumer Protection Act has two main provisions. The first is what we call a clawback provision. This says, should you receive a bonus for fraudulent financial statements, that bonus must be returned to the organization once it is discovered. And the second is what we call the whistleblower rules. Now, the whistleblower rules, your ears probably want to perk up, your eyes probably want to focus, because this is the big piece that you want to make sure you know about. The SEC pays 10 to 30% of sanctions in excess of $1 million to the whistleblower. So, you blow the whistle and you say, hey, I think there's a fraud being committed at XYZ organization. The SEC comes in and they say, hey, you're right, there's a massive fraud going on here. So we're going to impose sanctions in the amount of $10 million on this company. So you would receive $9 million times at least 10%, which tells you in this case you will see a payday of at least $900,000 for drawing the attention of the government to this fraudulent act. So if you think there is a fraud being committed, do not hesitate to report it. You could become very wealthy very quickly, especially if the sanctions levied are tremendous. Now, the next thing we want to talk about really quickly is this idea of GAAP. I'm sorry about that. Let me get my page back real quick. So the next idea is the idea of GAAP. And what GAAP is, as we said earlier, is the generally accepted accounting principles. These are the rules that we follow in the United States when it comes to accounting. So, basically in GAAP we want two things. We want relevance. So I don't necessarily want to know every single thing the company did. I just want to know about it if it's relevant. This means that the information affects the decisions of users. Now, this level of relevance changes depending on the organization that we're talking about. If I'm talking about a very small mom and pop shop corner store, it may be very relevant to you to know that they spent $25 on a trash can to sit on the corner of the counter. But if I'm talking about Walmart, which has billions of dollars, maybe you don't really care that they bought one $25 trash can. It might be nice to know. It might not be. But you're probably not going to base your investment decision on whether or not they bought that one $25 trash can. But if you're talking about a company that has only maybe $1,000 in total, they're just starting out, maybe you say, wow, $25 on a trash can, that's a lot, or that's a great deal, right? It may vary. But you want to make sure you're reporting relevant information. And the second piece that we want is what is called faithful representation. So faithful representation says information is accurate that the information accurately reports the results of the business. And that is what faithful representation does for us. Now, here is the deal. You say, great, GAAP tells us what rules we need to follow. These are the main two pieces we want out of that information. But who on earth decides what is GAAP and what is not? And the answer is the Financial Accounting Standards Board. This is the FASB. You will never see me write this all out again. You will see me abbreviate it as FASB. The FASB is who is going to go through and talk about all of this information and decide what is GAAP and what is not GAAP. Now the question, is the FASB the only one that can write these rules? You might want to say yes, but the answer actually is no. The FASB, for all intents and purposes, is who writes these rules, but they're only delegated that authority. They actually could lose the ability to write these rules and regulations at any time, because who is actually in charge of this is the SEC, which is the Securities and Exchange Commission. So the SEC is who is actually in charge of GAAP, but if you get a question about who actually writes GAAP, it is the FASB. But that authority is only essentially loaned to them by the SEC. If the SEC is ever displeased with the work that the FASB has done, the SEC could yank back that authority, take it away from FASB, and begin writing GAAP themselves. So they will oversee the proper use of GAAP by all companies that sell stock and debts to the public, and that is what the SEC does. Now, the question you may be asking is, it seems like there's a lot of rules, a lot of acronyms. Surely the world has agreed on accounting rules. Well, when is the last time the entire world has agreed on anything? And the answer is probably never. So, that just like in everything else, accounting is no different. Internationally, the rules are different. So if you're talking internationally, the rules are set by the IASB, which is the International Accounting Standards Board, and they promulgate something called IFRS. Now, this is essentially the equivalent of GAAP, but it's for the international community, and this is the International Financial Reporting Standards. Now, GAAP and IFRS, they're fairly similar in a lot of areas, but they have some substantial differences that are well beyond the scope of this class. If you want to really dig into those items and those differences, please pursue an accounting degree, and sometime in grad school we will really delve into that. But here in this very first accounting course, it is not important that you understand all of the differences. Instead, just know there is a difference between GAAP and IFRS. Know who the FASB is, know who the IASB is, and know what all the acronyms stand for. If you're doing that, you're doing good, right? This is your first time in accounting. We're not going to grill you on all the details. Now, the bright side of this and the good news is these standards are working to come together. You could say they're trying to close the gap. But what we're going to see is that this has been in process for over 20 years now, and there's still some major differences. So while we do expect a few areas to continue to come closer, there are just some fundamental differences that likely will never be resolved between the two. So you will have to be familiar that there are those two sets of rules for quite a while. Now, I will ask you to read through the conceptual framework on your own. It can get quite intensive, but it's not a whole lot of information. So please do read through that. Please do let me know if you have questions on that. I'm happy to help you understand it any way I can. But I do want to move on to what I would consider to be slightly more important here in chapter 1. So the next thing that we want to look at is what we call these principles, assumptions, and constraints. So this is probably one of the most important sections in chapter 1, without a doubt. I strongly recommend you get a very firm understanding of everything we are about to talk about. So principles, assumptions, and constraints. So first, we're going to discuss the principles. You will also need to know which of these are principles, which of these are assumptions, and which of these are constraints. So do make sure you understand that. The very first principle that we see is called the measurement principle. And this is the cost principle. Okay. So in this one, what we're saying is accounting information is based on actual cost. Information based on cost is what we consider to be objective. And this objectivity is what we strive for. This objectivity tells us that the information is independent and unbiased. Later, we will discuss something called fair value in later chapters. Do not worry about that now. Just know if you've heard that term, we will be discussing it later in the semester. Now, the next piece that we want to look at is what we call the revenue recognition principle. The revenue recognition principle basically says a couple of things. The first thing it says is that we can recognize revenue. Let me redo this real quick. So revenue is recognized when, and there are two pieces to this. So one, goods or services are provided to the customer. So they ordered something and we gave it to them. All right. At that point, we've done the work. So you can abbreviate this in your head and not necessarily think when goods or services are provided to the customer, but just think when earned. When you've done what you were told to do or what you agreed to do, you can recognize revenue. But only at the amount expected to be received. Now, for the first several chapters in this course, this second point is not very important. I think it picks up in chapter 7, where we actually decide to start really digging in to the second half of the revenue recognition principle. So for about half the course, you're going to recognize revenue at the amount that we're told. Later, we'll have to figure out the amount. But for the first several chapters, we'll have that given to us. The third section tells us here this idea of the expense recognition principle. And the more common name for this is the matching principle. So the matching principle tells us that an expense is recognized when an expense is recognized when it is incurred to generate the revenue reported. And that's it. So an expense is recognized when incurred, and revenue is recognized when earned. If you remember that little statement right there, you'll be in great shape for a lot of the questions that you will see. Because we will try to trick you up in a lot of the questions in the homework and on the exam, and it's really just trying to see if you truly understand this idea that revenue is recognized when earned and expenses are recognized when incurred. Just keep that straight and you will be fantastic when it comes to questions on this idea. And the last idea here is the full disclosure principle. So the full disclosure principle says that a company reports the details behind financial statements that would impact users' decisions. This is typically dealt with in the notes to the financial statements. Good news, most financial statements are only a page or 2 pages long. Bad news, the notes to the financial statements might be 1,000 pages long. So, when you look at a financial statement, you are getting the bird's eye view, the summary version of all of the stuff that is contained therein. If you actually want to know where those numbers came from and how many of the estimates were made, that's when you're going to have to start digging through those notes. So do make sure you understand that even though the face of the financial statement may look fantastic, it may be worth taking the time to really dig into those notes before you make a big investment in an organization to make sure you understand what you're investing in, how they're doing everything, all of those types of things. Now, the next thing we want to talk about here are our assumptions. So we talked about principles, now we'll talk about assumptions. So the very first assumption we want to talk about is called the going concern assumption. The going concern assumption says that the business is assumed to continue to operate into the future indefinitely. This is how we get to use what I'm going to refer to now as just typical accounting. If we understand that the business is likely to close in the next year, for example, because that's the time period we are concerned with in this going concern, then we will have to switch to what is called liquidation accounting. Liquidation accounting is a totally different basis of accounting. We will not talk about it in here. It is typically covered in an advanced accounting course, which is well beyond the scope that we want in this class. So just be aware there are those options for you if there was some reason that you thought the company was going under. Maybe they just declared bankruptcy and they're switching to this liquidation method of accounting. But that is what the going concern assumption says, is that the business will continue to operate indefinitely. Hopefully this assumption holds true so that we can simplify all of our records. The next assumption we want to talk about is the monetary unit assumption. So this tells us that transactions and events are expressed in monetary units. In the United States, this is typically the dollar, but it could be the euro, it could be the yen, it could be anything, right? Any monetary unit could be used, but this is what we're talking about, is that we are seeing dollars and cents on our financial statements and in those transactions and our journal entries. All of this is monetary. So when I look on, say, an agriculture balance sheet for a massive agriculture company that has 1 million head of cattle, and I see 100 million listed on their balance sheet for cattle, that's telling me that the valuation of that cattle is $100 million. I would not see 1 million head of cattle listed on my balance sheet. It just wouldn't make sense. There'd be no way for me to use that information. So what I've got to do is put the dollar amount or the euro amount, whatever it is, on that balance sheet so that we're being very clear. This is all in dollars, right? I'm not wanting to know how many head you have of cattle as much as I want to know the value of those cattle. So hopefully that clears up monetary unit assumption. Time period assumption. This is also called the periodicity assumption. So if you see that, just know it's the same thing. So the time period or the periodicity assumption says that the life of a company can be divided into time periods. So we can see reports for months, years, weeks, maybe even daily reports. But we can break the time period of the company into these time periods, and we can actually prepare useful reports. So, and useful reports can be prepared for these associated time periods. The next one and the last of the assumptions is what we call the business entity assumption. So the business entity assumption tells us that a business is accounted for separately from the person. So the business is on one side. There's this giant barrier dividing between the business and the person. So even if you have only one person who owns the business, in most cases, the business and the person are separate in the eyes of the law. There is an exception, and we will talk about it. But if you are a corporation, the business and the person are two distinct entities, which means the business can be sued, the person can be sued, but suing one does not necessarily involve the other. So hopefully that makes sense. And we'll talk about that as we talk about different types of businesses. So I'm going to briefly talk about the different business types. We're not going to really dig into them here, but there is some information in your book on them. So I do recommend you read through those. But basically there are 4 types of businesses we are concerned with. There's a sole proprietorship, a partnership, a corporation, and a limited liability company. You have probably often heard this referred to as an LLC, and we will refer to it the same way here. Now, briefly, I'm just going to go through a couple of items. So a sole proprietorship has, as it says, a sole owner. So a sole owner means there's one owner. It is not separately taxed as a business. The owner liability is what we call unlimited. So this means that you can actually lose your personal assets if your proprietorship fails. So if I started my own pizza joint and I did it as a sole proprietorship and I failed to run it well and my business went out of business, I could actually be forced to sell my cell phone, my shoes, my clothes to make those bills get paid. So that is a huge downfall to the sole proprietorship form of business. You do not have a separate legal entity in the eyes of the law, and when you die, the business dies as well. With a partnership, you have 2 or more people involved, so obviously you have a partner. That's why it's called a partnership. There is no separate business taxation, but the downside, of course, is, once again, the unlimited liability. And this is even scarier than a sole proprietorship, because you are equally liable for the stupid thing your partner might do. So even if you are very diligent, very hardworking, very conservative financially, right? You're not blowing your money, you're not spending a lot of money on things, you're very calculated, you're making sure you're only doing what's best for the organization. If your partner goes out and gets hammered, blacked out drunk one night, comes back and signs horrible contracts for your business, you're liable because you're in a general partnership. This means that even though you did everything right, because they were irresponsible, you could be forced to sell your house. You could be forced to sell your cars. You could be forced to sell your own personal assets because they made a poor decision. So before you go into a partnership with somebody, think of it like marrying them, because financially, you are. You're in that relationship with them, and it is committed, because you better make sure you both are making decisions, or you all are making decisions for the benefit of the organization, because that unlimited liability is still there. You still do not have a separate legal entity, and the business life ends with the death of the partners or by choice. It could also end, for example, if you have 2 partners and one partner decided to leave. If there is no longer a second partner, you do not have a partnership. Your business form has been reverted back to a sole proprietorship. The next type we want to look at is a corporation. Here we have 1 or more stockholders, also often referred to as shareholders. There is a separate level of business taxation, which is the huge downfall to the corporate form of business. But owner liability is finally limited. This means that if you go bankrupt as a corporation, you can lose every penny you ever invested in that corporation, but that is it. You cannot lose your own personal assets because you and the business are separate. There are cases where this can be pierced. In a corporate law class, you will talk about what is often referred to as piercing the veil. This can happen, it rarely does, but do be aware there are exceptions. But generally, we will say a corporation has limited liability. You do have a separate legal entity, and the business life is indefinite. A limited liability company also has one or more owners. There is no separate business taxation, which is a huge advantage. Owner liability is obviously limited, as it is in the title, and it is a separate legal entity. So it does give you a lot of the benefits of the corporate form of business without the downfall of the double taxation. So why on earth would you not always be an LLC? Well, there are certain limitations to business size and other things that make it not always feasible for a business to be an LLC. Now, there are certain firms that are very, very large that are opting to just be a general partnership. And you say, well, why on earth would you do this? Say you have 100 partners, and every one of you is liable for the actions of everyone else. It's very unlikely, especially as this firm gets larger, that you're going to have a very intimate knowledge of how each one of these people behaves. Are they all very responsible? Do they have a quirk? Do they have something that might make them make a rash decision? You may not know, but some companies opt for this very large partnership as a way to recruit customers. Because they say, look, we are so honest, we are so full of integrity that we are willing to risk everything we have because we know everyone in our organization is perfectly ethical, they're going to follow the laws, they're going to do everything appropriately. And so it may be a wonderful recruiting tool, but goodness gracious, is it risky. It really, really is. So be very careful as you make that decision on what type of business you might want to start. Typically, you might want to start with an LLC just to give you that limited liability and that separate legal entity. Now, we have finished talking about the business entity assumption and the other related assumptions. So now we will simply talk about the one constraint, but it has several pieces. So this constraint is what we call the accounting constraint. So the first part of this is what we call the cost benefit. So cost benefit. Cost benefit tells us we have to think, is this really worth it? To get any information, there is an associated cost. So while it might be good to have that information, if it costs us more than it's worth, we might not want it. So we must have greater benefit than cost. So benefit must be greater than cost. Now, this is not always true, right? If a judge or someone comes in and says you have to have that information, then maybe it doesn't matter that it costs us a little bit more than it's worth to us because that's been mandated that we have to do that. So there are certain instances, but if the company is debating getting certain information, they're definitely going to want to look at it through this lens. We've then got materiality. Materiality says, essentially, does it matter? Now, this is what we talked about earlier with Walmart. We talked about a $25 trash can. It's not going to influence your decision, so no, it does not matter. The way this is technically defined is, does it have the ability to influence decision making? If it does, it's material. If it does not, it is not material. And the last piece of this accounting constraint is what we call conservatism. Now, please do not mistake this for the Conservative or the Republican Party. It has nothing to do with that. Okay, it's not conservative or liberal in that sense. It's conservative in the sense that we use conservative estimates. So, we do not overstate assets or revenues, and we do not understate expenses or liabilities. So we're going to make the most conservative estimation when we are required to make estimates, so that we're providing the most accurate information to our investors. Now, what we want to talk about next is probably the most important equation you will see in this class all semester. There will be many equations, but this is without a doubt the most important equation you will see in an accounting class. Accordingly, it is called the accounting equation. If you only know one equation all semester because you refuse to learn the others, know this one, because this one is far and away the most important. And it says assets equal liabilities plus what we call stockholders' equity. So that's it. That's all there is. It's a pretty straightforward formula. This formula tells us what is on the balance sheet. If it is an asset, if it is a liability, if it is an equity account, it will land on our balance sheet. So the question we then have is, well, what on earth is an asset? What on earth is a liability, and what counts as equity? So we're going to answer that really quickly. An asset is something a company owns or controls. They're expected to yield what we call future economic benefits. And some common examples: cash, land, equipment, accounts receivable. Anything like this is what we're going to call an asset. The next section here is a liability. These are creditors' claims on assets. So this is an obligation, maybe to provide an asset, to provide a product, to provide a service to somebody else. A payable, so maybe instead of someone owing us, we owe somebody else. These are examples of future outflows of resources, and they include things like wages payable, accounts payable, notes payable. Frequently, you will see the word payable associated with these liabilities. And equity accounts, these are owners' claims on the assets. So you can actually rewrite this to say, I'm going to abbreviate stockholders' equity as just equity. And you could say equity is equal to assets minus liabilities. It's just a reworking, just some one-step algebra here to make that happen. And so you can see that this is also going to be called your net assets or your residual equity. All those terms just mean stockholders' equity. And that is our basic accounting equation. Now, that is going to wrap up just the basic talking that I wanted to do for this, and now we'll move into the actual homework assignment. So the homework assignment begins with this first exercise, and it tells us here, and we'll work through these pretty quickly because of the in-depth explanation we did up until this point. So if you do have a question about something, please do come back and ask me through email. Once again, don't ever hesitate to do that. I'm always happy to help you any way I can, but I've got to know that you do need help. If you don't reach out to me, I have no way to know that you're struggling. So please do not ever hesitate to reach out. I'm always more than happy to help any way I can. Now, the first option here says that Lannister owns Wealth Management. The business is a separate legal entity and pays an additional business income tax. So we see here separate legal entity and additional business income tax. Those are distinguishing characteristics of a corporation. So we do see that. And I'm actually going to switch over to the highlighter here just to make this a little bit easier to see. Next, it tells us that Riley and Kay own Speedy Package as a courier service. Both are personally liable for the debts of the business. So there is unlimited liability. Out of the two that we talked about, that would be either a sole proprietorship or a partnership. So how on earth did we decide it was a partnership? Well, you see there is Riley and Kay. That is two people, which tells you it must be a partnership. Ownership of Xander is divided into 1,000 shares of stock. The company pays a business income tax. So there's a bunch of red flags here that tell you this is in fact a corporation. One is that we have shares of stock that is only done in the corporate form of business, but we also see we pay a separate business income tax. Next, Russell is the sole owner of Wilson Sports, so we know it's not a partnership, but it could still be an LLC, it could be a corporation, it could be a sole proprietorship, but it says the business is not a separate legal entity, and there we have it. It's a sole proprietorship, and the business ends with his death. So lots of keys here that this is in fact a sole proprietorship. Next, we see that Trent Company is owned by Trent Malone, who is personally liable for the company's debts. So we've got one owner, personal liability, which is the same thing as unlimited liability that we discussed earlier. That tells us this is in fact a sole proprietorship. Next, Micah and Nancy own financial services, which pays a business income tax. Micah and Nancy do not have personal responsibility for the debts of financial services. So we do pay business income tax, which is the flag that this is in fact a corporation. Next, we see that Vera is the sole owner of Tech Solutions. The business is a separate legal entity and does not pay an additional business income tax. So separate legal entity does not pay additional business income tax. That is going to be a limited liability company. Next, we see here that IBC Services does not have separate legal existence apart from the one person who owns it. That tells us it is a sole proprietorship. There is no separate legal existence, there's no separate legal entity, and there's only one owner. So we know that is in fact a sole proprietorship. The next question is going to ask us to match each of the descriptions with the principle or assumption that it best reflects. So we'll run through these fairly quickly as we discussed them just a few moments ago. The first here says that a company reports details behind financial statements that would impact users' decisions. Of course, this is the full disclosure principle. It's the idea that we're not trying to hide information from decision makers, from investors, lenders, from other people. Next, it tells us that financial statements reflect the assumption that the business continues operating. As we said, this is one of our most important assumptions, as it allows us to avoid what is called liquidation accounting, and it is the going concern assumption. The next item that we see here is it tells us that a company records the expenses incurred to generate the revenues reported. This is the expense recognition or the matching principle that we see right here. The next piece tells us that concepts, assumptions, and guidelines for preparing financial statements, these are just the general accounting principles. Okay. Next, each business is accounted for separately from its owners. This is the business entity assumption. This tells me that if I own a business and I go out and I buy my girlfriend an engagement ring and I want to have that, I cannot list that engagement ring as an asset on the company's balance sheet. It doesn't work. It's two separate things. So make sure you understand that, right? So if you're going out and you're wanting to buy something for your significant other and you own a business, it cannot be included on the business records. You'd want to make sure to have those separate. Next, it tells you here that revenue is recorded when products and services are delivered. That is part of what we call the revenue recognition principle. Do you remember that is not the entire revenue recognition principle, as the second piece discusses the idea that we can only recognize the amount we expect to collect, which we will deal with in Chapter 7. Now here it gives us detailed rules used in reporting specific events and transactions. Those are specific accounting principles. And finally, information based on actual costs incurred. That is our measurement or our cost principle. That is also a very important principle, as it will determine how we record many transactions throughout the rest of the semester. Now this question just asks us, can we do some basic algebra? So basically we're trying to solve for the amounts in the yellow boxes. And so what we're going to see here is how to do that. So if we are told liabilities are 49, equity is 46, we are asked what amount would assets be. Well, if you just take 49 plus 46, you will come out to $95,000. And that's exactly what we see. Now I'm going to switch back to the pen real quick. And in this case, we're told assets equals liabilities plus equity, but we want equity. So I just move liabilities over. So I say assets minus liabilities equal equity. So I take 120 minus 37, and I see that that is $83,000. Now in this case, I'm told I have 116 in assets. I'm told I have equity, and I want to know my liabilities. So I just move equity over, and I solve for liabilities. So here I have 116 minus the 62 in equity, which tells me I've got $54,000 in liabilities. And so we see how all three of these numbers are calculated. It's just showing you can solve for any of these three as long as you have the other two. Just some basic algebra that we've got to be able to do here. But the good news is it's about as complicated as the math is going to get all semester. Accounting is not difficult because of the math. Accounting can be difficult because of all the rules sometimes, but do not let the math intimidate you. I'll walk you through every bit of the math that you need this semester. I'm not assuming you have any complex knowledge of math, as I certainly do not. So we will get through the math together, and it is a necessary evil in some cases, but in my opinion, without the math, the theories in accounting are far more difficult to comprehend because you can't see it working. So I will do everything I can to bring in numbers, to bring in examples all semester long to help you make sense of this information so that you can very easily understand what we're doing, why we're doing it, how it's impacting everything, how it's all related, to try to give you the most full understanding possible. So here in question number 4, we are told at the beginning of the year Addison Company's assets are equal to 164, equity is 123. So if we look at this table, it told me right away that beginning assets are 164. That drops right here. Beginning equity, 123. Boom, right there. Immediately, what do I need to do? 164 minus 123 equals 41,000. I can go ahead and fill in that top row for my beginning. Then it tells me during the year assets increased by 80,000. So I say increase of 80. And liabilities increased by 49,000. Boom. Now, what is equity at the end of the year? Basically, two ways to figure this out. So we'll go through both. One is to say, well, the change on the left side has to be equal to the change on the right side. So if the left side went up by 80, then the right side must also go up by 80. So far, we've only gone up by 49. The difference there, 31. So I see an increase of 31 right there. That's one way to get there. If that works for you, do that. I don't have a preference how you get here. The other way is to say, okay, well, 164 plus 80 is 244. So I know my total liabilities and equity must be 244. Now, my ending liabilities were 90. So I see I've got 154,000 that I need right there. But to get there, I need to figure out the change. So I then back out my 123 that I started with, and I can see an increase of 31,000 right here. So however you need to do it to get these answers, do it. Whatever makes sense to you is fine. There's almost always more than one way to get to these answers, and if there is, I will do my best to show you the multiple options, to give you as many possible ways to understand this as possible. Once you've found a way that makes sense to you, ignore me. Don't let me confuse you by giving you more options, but I want to make sure you see all the different ways that you might be able to get to a solution, and in some cases, you need to know different ways because you never know how the information will be presented. So just make sure you know that. Next, we see here that Office Store Company has assets equal to 184,000 and liabilities equal to 150. What is the equity? Well, once again, we'll just take 184 minus 150, and that tells me that's $34,000 in equity. Now, the last piece here says at the beginning of the year, Quaker Company's liabilities equal 74. During the year, assets increased by 60. At year-end, assets equal 190. Liabilities decreased by 6,000 during the year. What are the beginning and ending amounts of equity? So, how on earth would we solve this question? It's going to be very similar to what we had in the last one. So let's just walk through it. At the beginning of the year, liabilities equal 74. Boom, 74. During the year, assets increased by 60. Boom. And at year end, assets equal 190. So if I increased by 60 during the year and I'm ending at 190, then my beginning must be ending minus the increase, which tells me my beginning is 130. Now, we're then told liabilities, on the other hand, decreased by $6,000 during the year. So if we began with $74,000, liabilities decreased by $6,000, then we see a $68,000 amount will be my ending liabilities. Now, you may be asking, what on earth are these brackets or these little triangle things? In accounting, we simply use that to show a negative, right? If you go into an accounting format in Microsoft Excel, you'll find something very similar with parentheses if you go in there. So we do that just to help us visually see very quickly that this is going to be a subtraction, and I'll probably be doing this for most of the semester. You could also just write this, of course, as 190 minus 60. Whatever is fine, whatever makes more sense to you is fine, but this is the notation I will be using during class and during these videos. So there's your 68,000. What they now want us to know is, well, what are my beginning and ending equity? Well, now that I've got all this other information, this becomes quite simple, because now I can simply say, well, I'll take 130 at the top minus 74, and that'll give me my 56. And then I will come and I will take my 190 minus my 68, and that will give me 122 right there. So many ways you can solve these questions. Hopefully working through those has helped you see that this is not too bad, but this can get rather involved depending on how the question is asked. Now this question will take a while for you to do. I'm not going to work through all of these. I'll work through maybe the first 4 or so, just to give you an idea on how these will work. And then you'll work through the rest of them in your homework assignment. But make sure you understand why these are working the way they are, and make sure you see where you're at in this table. So before we start, I'm just going to draw a few things. And I'm just going to come in here and say, right after the end of this assets, I'm going to draw this big blue line. Then I'm going to do the same thing after liabilities. And I'm going to do the same thing after equity. So that you can very clearly see when we're in an asset column, when we're in a liability column, and when we are in an equity column, so that you don't get confused. So we'll do that. And now we will dive into these questions. So the way this is going to work is it's going to give us a couple of scenarios here. You're going to read through it and see what is changing. Is an asset increasing or decreasing? Is a liability increasing or decreasing? And is an equity increasing or decreasing? So it tells us Ming Chen began a professional practice on June the 1st and plans to prepare financial statements at the end of each month. During June, Ming Chen, the owner, completed these transactions. So the very first here tells us the owner invested $62,000 cash in the company along with equipment that had a $23,000 market value in exchange for common stock. So the very first thing you're going to have to get used to in this class is you are the business. You are not Ming Chen. You are the business. So make sure you don't think about this from Ming Chen's perspective and say, oh, he gave up cash. Cash went down. That is not, in fact, what happened. What happened is cash actually has increased, and that is because the business has received cash. So you see an increase of $62,000 in cash right there. Now, what else did the business receive? The business also received equipment. How much? $23,000 worth of equipment. But what did the business give up? What did the business get on the other side of this? They received common stock. So the equity account common stock is going up because we gave that to the owner. And the equipment and the cash balances are going up. And you say, whoa, whoa, whoa. What's going on? I got cash and equipment. I understand why those went up. But shouldn't that common stock number be negative? Because the company gave up common stock. You're thinking about this all wrong. Okay, slow down. Slow down. That's not what's really happening. What's happening is the company is increasing the amount of common stock in the company. And if you want to see the math on this, what you would be saying if you made that a negative is that assets equals liabilities plus equity. Well, in this case, your total assets are 85. That's your 62 plus your 23. There were no liabilities, but now you're saying that 85 equals negative 85. That's not true, right? Positive 85 is not the same thing as negative 85. You know this is positive, so even if it doesn't quite make sense yet why this is positive, you know it must be positive and that this is wrong. So do make sure you understand that, and you can kind of check yourself as you go because each row should equal out. So there we go. So 62 and 23, 85, and 85 on the right side. 85 on the assets equals to 85 in liabilities and equity on the right side of the equation. Perfect. No problem with letter A. The next one here says the company paid $1,900 in cash for rent of office space during the month. Now, expenses are part of equity. It may not make sense yet. It will when we talk about the income statement later. Right now, not a huge deal that you understand why. Just understand expenses are part of equity. So, what happened? Well, we paid cash. So cash went down. And you see this notation where they have put the cash going down in parentheses, and that's exactly what it means, is cash has gone down. But you'll notice expenses went up. The expense has gone up. So you say, whoa. I don't like this. I've got a negative on the left, but I've got a positive on the right. This doesn't balance. Almost. Look at what is in this box right here. It is a minus sign. So you are reducing equity by $1,900. At the same time, you are reducing cash, which is an asset. An asset has now gone down by $1,900, and equity has gone down by $1,900. Your accounting equation is still in balance. So do not get confused and start trying to match the parentheses up. You may not, right? Depending on what accounts you're using, you may see them handled slightly differently. So the next one that we want to look at here, letter C. The company purchased $15,000 of additional equipment on credit, payment due in 30 days. So, have we paid any cash yet? As of this time, no, we have not. So we purchased additional equipment for $15,000. Boom, right there, $15,000. But you'll notice cash not affected, because we bought this on credit, which means we will pay cash at a later date. So what is affected? A liability. What liability? Accounts payable. And this tells us that at some point in the future, we're going to have to pay this, but it's not today. And that's exactly what we see, payment due in 30 days. So in 30 days, we will pay this $15,000. But today, we are not paying $15,000. We are simply agreeing to this liability. Now in letter D, we see that the company completed work for a client and immediately collected $1,800 in cash. So we completed work. So what does that sound like? If we have done the work and we have billed it at the amount we expect to collect, sure enough, that is a revenue. And that's exactly what we see. Because we already collected the cash, it goes to cash immediately. So you see that $1,800 going up in assets and that $1,800 going up in equity. The left side of the equation went up, the right side of the equation went up. We're all in balance. Now, what would have happened if instead of receiving cash right away, we'd only received part of the cash or none of the cash right away? So say they didn't pay me yet, but they'll pay me next week when they get paid. Then, until I get paid, I have an accounts receivable. At the time that they do pay me, I reverse the accounts receivable and increase the cash. Not super important right at this time to understand all the intricacies, but when we get to chapter 2, when we start recording journal entries, you'll really be able to see that you understand this material. So make sure you take your time walking through the remainder of these and make sure you understand why they are what they are. Once again, if you are struggling, especially on this question, please reach out to me, because this question is going to be a very good indicator of how you're doing before we get to chapter 2, where we really hit into the accounting. So make sure you understand this question and every piece of it. Now the next question here is dealing with an income statement. So we're going to look at how we actually prepare our very first financial statement. So we're told on October 1st, Ebony Ernst organized Ernst Consulting. On October 3rd, the owner contributed $83,000 in assets in exchange for common stock to launch the business. On October 31st, the company's records show the following items and amounts. Retained earnings as of October 1st is $0. Then they give us all this information. So what we need to know is, well, what information is going to go on the income statement? What's going to go on the statement of retained earnings on the balance sheet? So, big picture right now, early in the semester, what goes on the income statement is revenues and expenses. There are other things we will talk about later. For now, revenues and expenses are what you need to know. So, what we'll see here is, as we look through here, we say, is cash. Is that a revenue or an expense? No, but it is an asset. So I'm just going to put an A out to the side. What about accounts receivable? Oh, there's another asset. Office supplies? Yep, that's an asset. Land? It's an asset. Office equipment? Asset. Accounts payable? Is it an asset? No, it is a payable, which means we owe money. That's a liability. Common stock? There's your equity. Cash dividends. I'm not going to label them because they're really just what we call a dividend. They're not an expense. They are a dividend. So please do be aware of that. I'm just going to make a note here that this will go to the statement of retained earnings. Okay, so statement of retained earnings. Consulting revenue, that is a revenue. Rent expense, that is an expense. Salaries expense, once again an expense. Telephone expense is an expense. And miscellaneous expense is an expense. So, as I come down, I'll say anything with an R next to it for revenue will go in this top section for revenues. You'll notice they gave you 3 lines. You only need 1. Don't be fooled on the homework and think they gave me 3 lines, there must be 3 revenues. That is not the case. In this case, only 1 revenue is needed. So you just drop it in there. $12,940. And that, of course, comes right here. The next thing we see is our salaries expense, our rent expense, telephone, and miscellaneous expenses. Right here. All 4 of these simply drop straight in here. Now we total these up. So if you do 5,920 plus 2,640 plus 800 plus 620, you will get $9,980 for your total expenses. Once again, you'll notice there are some blank lines. Do not let this fool you into dropping something else in there. Nothing else goes there in this case. Now, the difference between your $12,940, your $9,980 is your $2,960. In this case, revenue exceeded expense, so you do have net income. If revenue is less than expenses, you do not have net income, then you have what we call net loss. But in this case, you do have net income. Now, for the statement of retained earnings, what we do is we start with beginning retained earnings, which they told us as of October 1st was $0. So we just drop that right in. You're then going to add net income, $2,960. But one thing you're now going to have to take into consideration is the dividend. Dividends are not an expense. So write it with me. Dividends are not an expense. Please, if I ask you on an exam, are dividends an expense or anything related to that, you need to say no. Dividends are not an expense. Instead, they are a direct reduction of equity. They do reduce the equity section of the balance sheet, but they are not an expense. We will dig into this throughout the semester, but for now, just think of it like this. Earlier we talked about this thing called the matching principle that said that you can only record an expense paired up with the revenue it helped generate. But when somebody buys stock in your company, they do not record that as revenue to the organization. It is recorded as a direct increase to equity, which means when you give that money back through the form of a dividend, it does not go out as an expense because there is no revenue to match it against. Instead, it goes out as a direct reduction of equity. And that's exactly what we see here, is the subtraction of the dividends right there. So there you go. So all that's left in retained earnings at the end of October is $1,840. Next, we're going to prepare the balance sheet. The balance sheet tells us that we've got cash of $14,550. So I'm just going to take a snippet real quick of that, and we'll just drop it right down here, paste image. And so now we can see what notes we had made earlier. So you can see cash, $14,550 right here, drops right there as an asset. Accounts receivable, $12,940. Office supplies, $2,400. Office equipment, $17,020. Land, $45,860, $45,860. I have no idea why they switched up that order. They do that sometimes. That's all right. Not the end of the world, but we're going to go ahead and include all of that. When you total that up, you see that your total assets equal $92,770. Now, your liabilities, I'm going to use a different color. I'm going to use red. $7,820. Oops. Somehow we lost our table down there. Not exactly sure what just happened. Let me recopy that real quick down to the bottom for us just so we can still see it. Sometimes this seems to happen. I don't know for sure what causes it. But now we can see that for our accounts payable, we do have this $7,820 and the $7,820. Total liabilities then, just $7,820. Now you'll see common stock, $83,110, $83,110. But if you take this $7,810 or $7,820 plus the $83,110, you will notice you do not equal to $92,770. And the reason is because you must bring down this $1,840 from your statement of retained earnings into your balance sheet. When you do that and add that to your equity section, now your total equity is $84,950. Your total liabilities remain at $7,820, and the sum of $84,950 and $7,820 will give you the grand total that we're looking for of $92,770. And you will notice that our total assets, in fact, do equal our total liabilities and equity. This is called a balance sheet for a reason. It should balance. If your balance sheet is ever out of balance, you have made a mistake. Please turn around and figure out where that mistake was made so that you know you can get full credit on the question. Because your balance sheet balances does not necessarily mean it is right. You might have forgotten something off both sides if you completely forgot to record a transaction. That could happen, but I guarantee if your balance sheet does not balance, it is wrong. So make sure you do guarantee that your total liabilities and equity do in fact equal your total assets, which is what we said with that beginning accounting equation so long ago. Now in number 11, we are going to look at the statement of cash flows. Do not worry about completing this question. I have it assigned in chapter 1. Some semesters I take it out, but I typically give you full credit on this question in chapter 1 simply because this is beyond the scope of chapter 1 that I want to talk about. We deal with the statement of cash flows entirely by itself in chapter 12. You will get more information on the statement of cash flows than you ever thought you could even want when we talk about this in chapter 12. For that reason, I am not requiring you to do it in chapter 1. If I've not mentioned this in class or something at this point, please do send me an email. I'll be sure to go in and give everybody credit for this question. If you want to do it just on your own, please feel free to do so. But the statement of cash flows is prepared in a method in a way counter to how we prepare the other three. And at this point in the semester, I don't want to confuse you by going back and forth. So we're just going to hold off on preparing the statement of cash flows until we hit that in chapter 12. But when we get there, we'll have all kinds of fun with the statement of cash flow. Now, the very last question here is very similar to what we had on the number 7. Once again, you will be responsible, in this case, for column B. Because of the way the question is done, there's no way for me to give you credit on this section. So do make sure to work through it. Ask me if you have any questions on it. I'm happy to go over it with you, but I don't want to beat it to death in this video because this video is already quite long and I want to make sure you're getting the most for your time. But as you struggle, if you do with this section, please do shoot me an email. I'm more than happy to help you figure it out. But at this time, I'm going to skip through that, and we're just going to talk briefly about the balance sheet section and the income statement on a couple of these. And once again, just like on number 7, I'm not going to work through all of these simply because of the time, but I will do the first 3 or 4 just to give you an idea of how I would work through this. So here we see that an owner invests $400 cash in a business in exchange for stock. So what has just happened? Well, cash has gone up, which has driven total assets up. So we see that right here. We also know equity has gone up by $400. Technically, this is a financing activity on the statement of cash flows, and so that will increase right there. So the first row is done. The second row receives $200 in cash for services provided, while cash has gone up by $200. Equity's gone up by $200 because that is a revenue, and revenue is part of equity. Income statement, net income has gone up by $200 because revenues will increase net income. And operating activities is where we deal with day-to-day operations on the statement of cash flow, so we'll see that increase of $200 right there. Next, we see that we paid $320 in cash for employee wages. So total assets has gone down because cash has left the business. Total equity has gone down because this is an expense, and expenses reduce equity. Net income has gone down because we have incurred an expense. And operating activities on the statement of cash flows have gone down because cash has actually left the business as well. The fourth one here tells us that we bought $450 worth of equipment on credit. So total assets, we bought $450 worth of equipment. So equipment has gone up by $450. And you might say it's a wash because cash has also gone down by $450. But slow down and be careful. We bought this on credit. Because we bought it on credit, no cash has left the business yet. So what's actually happened is a liability has increased by $450. So an asset went up by $450, a liability went up by $450. Was there an effect on equity? No. Was there an effect on net income? No. Only revenues and expenses go on the income statement since this is a purchase of an asset. With the pickup of a liability for $450, there is no impact on the income statement, and for that reason, no effect on the income statement. Also, because there has been no change of cash, either in or out of the business, there is no impact on the statement of cash flows. So hopefully that gives you an idea of how you're going to handle each one of these questions. Once again, please do not ever hesitate to ask me if you need help, if you have any questions. I'm always more than willing to do what I can to help you get this to make sense. I know it's a lot of information. I know it's going to be a lot of work, but I think if you really put in the time in this course, you'll get out of it what you put into it, and hopefully when you get out of here and you get into the real world and you get into these situations when your boss comes up to you with a question about something or anything like that, you could actually have some input that is really valuable, that could really help your organization succeed, that could help you get promoted a little bit quicker, that could help you live a little bit better, that could really change the way that you see things and help you make better decisions. So once again, I hope this video has helped you. I hope you found it as entertaining as an accounting video can be, and I hope we'll see you.